Hey everyone! Today I'm diving into the essentials of financial market risks all in just 3 minutes. Understanding these risks is crucial for anyone involved in the financial markets, whether you're a seasoned investor or just starting out. If you're an investor or simply keen on grasping the nuances of financial markets, stick with me. We'll break down the different types of risks you might encounter and how they can impact your investments. First up, let's talk about market risk. This is one of the most common types of risk and it affects everyone in the market. This is essentially the risk of losses due to changes in market prices, and it comes in several flavors, each with its own unique challenges and implications. Equity risk. This is the risk that stock prices might fall. It's something every stock investor has to deal with, and it can be influenced by a variety of factors including company performance and broader economic conditions. Interest rate risk. Changes in interest rates can impact bond values significantly. When interest rates rise, bond prices typically fall, and vice versa. This is particularly important for those investing in fixed income securities. Currency risk. Fluctuations in exchange rates can mess with your investments. This is especially relevant for those investing in foreign markets or dealing with international trade. And lastly, commodity risk. Volatility in the prices of things like oil or gold. These commodities can be highly volatile, influenced by geopolitical events, supply and demand dynamics, and other factors. Next, we have credit risk. This is a critical concern for lenders and investors alike. This is the risk that a borrower won't be able to repay a loan or meet their contractual obligations. It can lead to significant financial losses for lenders and investors. It's a major concern for banks and bond investors. They rely on the borrower's ability to repay to ensure their own financial stability. Tools like credit ratings and credit default swaps are used to assess and manage this type of risk. These tools help investors gauge the likelihood of default and take appropriate measures to mitigate potential losses. Now let's discuss liquidity risk. This is a risk that can catch even experienced investors off guard. This refers to the risk of not being able to buy or sell assets quickly without affecting their price. In times of market stress, liquidity can dry up, making it difficult to execute trades at desired prices. For instance, during a market crash, even valuable assets might be tough to sell. This can exacerbate losses and create a vicious cycle of declining prices and reduced liquidity. Think of it as trying to sell ice cream in a snowstorm. Tough luck. Then there's operational risk. This type of risk is often overlooked but can have severe consequences. This includes failures in systems, processes, or even due to human error or fraud. Operational failures can disrupt business activities and lead to financial losses. Imagine a cyber attack on a bank. That's operational risk in action. Such incidents can compromise sensitive data, disrupt services, and damage reputations. Finally, we have systemic risk. This is perhaps the most daunting type of risk, as it can affect the entire financial system. This is the risk of a collapse of an entire financial system or market, like what happened during the 2008 global financial crisis. Systemic risk can lead to widespread economic downturns and require significant intervention to stabilize. It's interconnected and can be triggered by the failure of one big institution. The ripple effects can be felt across the entire economy, affecting businesses, consumers, and governments. Now I know this all sounds pretty intense, but here's the good news. Financial market risks are manageable. With the right strategies and tools, you can navigate these risks effectively. Institutions use tools like diversification, hedging, credit assessments, and regulatory oversight to reduce these threats. By spreading investments across different assets and using financial instruments to offset potential losses, risks can be mitigated. So as future professionals, recognizing these risks can help us make better decisions and build more resilient financial systems. Thanks for tuning in. Remember, knowledge is power when it comes to managing financial risks. If you found this overview helpful, give it a thumbs up and consider subscribing for more insights into the world of finance. Catch you next time.